All right, great. So we're wrapping up on 305, so I'm going to go ahead and get started. Just a couple of quick thank yous. I've got a handful of individuals on here that have hopped on that I want to say thanks to. First and foremost is my mom. She is one of my role models and mentors. She started her business when I was in high school, and I helped her with her QuickBooks. And so as I've grown up and looked at business owners, she's been an individual who I've been really thankful to be able to call, ask questions, ask for advice, ask for guidance. So thanks, Mom and Dad, for hopping on. Also got Dr. Ruffin on. He is one of my mentors as well, from home. I'm from Alabama, for those of you on the call who don't know that. He was a senior research scientist at AM RDEC, and he taught me everything I need to know about hard work. The stuff that I was learning from him, I don't apply anymore because we were doing missile guidance, but he was a great example for me. So as we've got a couple more people hopping on, thanks Sherry for hopping on. Thanks Stan for hopping on. Mike Kovalich, he's been a great help for me. He introduced me to Ernest Greer over at GT Law. Mike, thanks for hopping on. I got a couple of brothers from 100 Black Men in the Bay Area, and actually a couple from some of the national chapters. Thank you guys for hopping on. David and Anna, thanks for hopping on. And David and Hepsi, thanks for hopping on. Quinn, I see you. Quinn's one of our interns coming into the summer. All right, so now we've kind of got we've got a general idea of who's on the call. Looks like a handful of us have been investing for some time. For the younger audience, perhaps, they're the Robinhood account. Robinhood is, for those who don't know, an app that you can trade stocks from your phone. And here we've got a lot of people that are also looking to learn more. So let's just hop into what we're doing. A bit about our background. So I started working with the federal government. The TSP is Thrift Savings Plan, and that is the retirement plan that all employees receive if they work for the federal government. And I started out in my career by building call centers that supported the Thrift Savings Plan. And what we would do is we would contract with insurance companies and investment firms, and we would create proposals and strategies for them to go and share their products and compare them to the option in the Thrift Savings Plan. And so I did that for a very long time. And our largest client was New York Life. And in 2018, New York Life introduced us to a startup in San Francisco called For Us All. So my wife and I ended up moving to Palo Alto, which is a good hour from San Francisco, in 2016. And so it just so happened that we were near proximity. And so For Us All, although they were a startup, they were also in the retirement space. And they needed a team that was already familiar with the industry to help them draw in retirement assets. And so we contracted with them for the year 2018. And as they got started, they hired 9 of our telemarketers, 8 of our telemarketers, plus myself overseeing that team of 8. And we got them from 0 to 500 million in assets, just using our call center and the strategies that we'd been using for New York Life, MetLife, Mass Mutual, Forrester, some of our other insurance companies on the federal government side. And so when that happened, 2019 came around, and I started to ask myself what it would look like if I were to actually register a company with the SEC and start providing advice on behalf of my own entity, as opposed to supporting other organizations as I had been for such a long time. The reason why I wanted to do this is after such a long time of seeing everyone's products and reviewing how the products worked and teaching them how to sell their product against a competitor, I came to a place where, from a conflict of interest standpoint, I felt that I understood what was in the best interest of a investor. But I also felt like often when you were presenting information to an investor, they didn't know what was in their best interest. And so as a result, I said, hey, I'm going to register myself. I'm going to go the RIA route, which is an independent registered investment advisor. And what that means is we're registered with the SEC. We can sell any product in the universe of equities, whether they be private equities or public equities, but We can do that at our own discretion. And by law, we're required to do what's in the best interest of the individual that we're working with. So it's a lot different than a relationship with the stockbroker, for example, where they can give you a product as long as it's suitable, but it doesn't necessarily have to be in your best interest. So fast forward to today, we launched again with myself and actually 3 other individuals' assets. So we started with nothing. We didn't come from an investment bank where we had a large book of business or something like this. And the goal that I had was to actually work and continue to work in the retirement space. And so as of today, we currently custody 85 million in assets. The majority of those assets are retirement plans. And as a result of COVID, the pivot that I decided to take was, as I was waiting for business to open back up, I said, hey, we have this lens of history fund. We can place it in retirement accounts. But what we should do is see if there's some individuals that would like to participate, that would like to understand how they should navigate through the markets. And I don't know how long the markets will be like this, nor do I know, how frequent this will be to the advantage of the investor. But I did think it would make sense, as opposed to focusing solely on retirement assets, to start reaching out to individuals, especially since now we've got some momentum and they can see that, they're working with the team that is not at the very, very ground level. In the world of asset management, 85 million is still very small. The numbers get kind of goofy in terms of how big, organizations can get. But that's where we are as of today. So when I decided to establish this lens of history fund, I wanted to make sure that regardless of market direction, whether it was going up or whether it was going down, I'd be able to add value for my clients. And my ultimate goal was really, as it reads, was to be able to invest in companies that, through the lens of history, would outperform in short-term scenarios, as well as in the long run, regardless of market conditions. So at a high level, I build portfolios with a mix of companies that have a low correlation to the market. So let's talk about market correlation. So I mentioned, low correlation. So when I'm investing for clients, I always want to make sure that they understand what I'm doing. I've seen a lot of portfolios, and a lot of times a client will come to me and they'll say, hey, here's our portfolio. What do you think about it? And when I start digging deeper and asking questions, I often find that they're not aware of what they have, right? They know how much money they have, but they don't understand what is the underlying investment that I've been given. They'll see some symbols and some tickers, but they won't actually know what they've invested in. And so what I want to do today, regardless of who you're investing your money with, I want you to be able to walk away and be very clear as you go back and look at your portfolio, what you actually have, and have an understanding of how you should make decisions that are in your best interest. So let's talk about correlation. You guys see the arrows. A stock that has a positive correlation, it means that it moves the exact same direction as another stock. So this is a comparison. So the range is from -1 to 0 to 1. So a stock that has a correlation of 1, so perfect correlation, is exactly what you're looking at here. When one stock's going down, the other stock's going down. When one stock's going up, the other stock's going up. When one stock's going down, the other stock's going down. That's a correlation of 1. A correlation of 0 means that it's random. It means that you look at a chart and you wouldn't be able to really see a correlation. And a correlation that's negative means that when one goes up, the other goes down. So the simplest example of that is bonds. When stocks go up, bonds go down, right? Now, there's no such thing as a perfectly negative correlation. So there isn't a -1 in real life. Bonds don't perfectly go the exact opposite, but they will have a negative value. All right. So now we're popping into our first question. So look at your cell phones and you can see my mouse here. So what we're looking at, this is ExxonMobil is this blue line, Tesla is the red line, and treasury bonds are this yellow line. And so what the question is, it says the market's been going up since 2013. Which portfolio has a positive market correlation? And what you'll do with your finger is you'll just press either on Exxon, on Tesla, or on treasury bonds. Make sure that you guys can see this. I can see it. All right. Yep. So everyone should be able to do it. Is that working for you guys? I don't see any responses yet. Okay, I got a note that says it's not letting you select. Let's give me like 10 seconds and let me see why. Okay, and since I don't know why, what I'm gonna do is just tell you guys the answer. Yeah, let me see if this is gonna let me refresh the question for you. Okay, try now. So yeah, you'll click Exxon, Tesla. Oh, okay, now I think it's working for people. Yep. All right. So now we are in good shape. Okay, great. We got lots of answers now. Okay, it's working. Great. So we have a couple of people who've selected treasury bonds. We've got a couple of people who have selected Exxon, and it looks like the majority of the team has selected Tesla. So let's read the question again. It says the market has gone up since 2013. So generally, the market has a correlation that's positive, right? The market is correlation of 1. That's the benchmark. The market is 1. And this says which portfolio has a positive correlation. So the answer is in fact Tesla. Now the reason it's positive correlation is although Tesla is shaky like this, Tesla is also the only chart on the screen that has gone up over that same period of time. So correlation, Tesla doesn't have a correlation of 1, but it does have a positive correlation to the market, right? Exxon, even though the market has been going up since 2013, has gone down. And treasury bonds, as you recall from the previous slide, when the market goes up, bonds go down. So they have a negative correlation to the market. So the correct answer is, in fact, Tesla. So let's go to the next one. And then here we go. Similar type question. If the S&P has gone up since 2011, which stock has a market correlation of 1? So this is a question on perfect market correlation. All right, so it looks like we're getting, there we go. Who's it gonna be? Who knows? See, the thing is, if everyone doesn't get this one right, it means that I need to do a better job explaining things. So, or maybe phrasing the question. So again, the S&P has gone up since 2011. The S&P is a benchmark of 1. Which stock has a perfect market correlation of 1? The answer for those in green, they are correct here for the S&P. Now, the reason for that, again, the S&P follows the market. It is the market. It is the benchmark. So it has a correlation of 1. Now, I'm spending time talking about correlation because it's important to understand if you want to build a portfolio that is going to outperform over time, that you need to really take into account correlation, right? If the market's going down, you need to have a non-correlated asset that's going to go up during that time frame. You don't want to have a portfolio that when the market tanks, or even if it corrects, right? Even if the market corrects 10%, if you don't have an idea of how you can position your portfolio during that correction to actually benefit yourself, you're just following the general trend of the market, right? So when we speak about diversification, in practice, any portfolio that has around 20 stocks is considered a diverse portfolio. I've seen several portfolios that will have, 50, 60, 70 different ETFs, mutual funds, and it looks very, technical or complicated. But really, you don't need that many positions in order to have a diverse portfolio. What you need are 20 companies or so that are not all in the same industry. So right underneath that asterisk, I put the top industries. And if you were to take 2 companies from technology, 2 companies from consumer products, 2 companies from healthcare, just make your way down the list. And you say, okay, what are 2 companies that I think are really good in technology? My favorite 2 tech companies. And, work your way down that list. You'd end up with 20 or so companies that you believed that in general were better than average, right? And if you're not sure, you can always look at what the experts think. So let's say, for example, you don't know anything about real estate. You don't know what will be a good real estate investment to make. You can always look at the ETFs, the underlying ETFs that track the index, and see how the professionals are ranking that. So let's just use technology since everyone's aware of all the technology companies. Without even doing a poll, I would assume that the majority of people would say, hey, top 5 tech companies, Apple, Google, Facebook, Microsoft, who else you want? Oracle, right? So there you go, top 5 companies. These are companies that you think, as far as technology is concerned, those companies are going to do well through the lens of history. It won't matter if you invest in them this year, 10 years from now, 10 years ago. These are companies that through the lens of history, they're making big moves. Now, once you come to that conclusion, you can always check your work. So what I have here is the S&P 500 index that a professional built, right? And so if you have this ETF in your portfolio, which probably the majority of the people on this call actually have this, it's the most common ETF in a portfolio. And what you'll see here is, again, even without understanding what an ETF is or anything like that, you'll see that they've put 5% of all the assets in Microsoft, 5% in Apple, 4% in Amazon. These are companies that everyone's familiar with. So they're doing the exact same thing that we're talking about on this call. The difference is this ETF is made up of a large group of holdings. We're only looking at the top 10, right? There could be an underlying number of holdings of say 300-400 companies that make up this index. And the reason why they do that is because the product is designed to follow the S&P 500. This product is not designed to outperform the S&P 500. That's really important to differentiate. So if you are buying any ETF or any mutual fund, yes, they want to slightly do better than the market, but their goal isn't to be non-correlated to the market. That's what we want to realize. Their goal is to, if the market's going up, they're going up slightly more. If the market's going down, they're going down slightly more. And why would that happen? Because of the weighting here. Since they have a heavier weighting with Microsoft, Apple, Amazon, Facebook, Google, Johnson & Johnson, Berkshire, Visa, these top 10 companies that we see here, in a strong market, they're going to perform better than the other, typically than the other companies that have less weight. And also in a down market, they're going to recover faster. And I'll show some examples of that in a little bit. So now what you're looking at, I've taken 3 portfolios. So you can take a screenshot of this if you want. What I've got here is our current lens of history fund. And you can see the positions that we're currently in as of today. Only difference here is I'm actually not in this extended duration any longer. So you can move that 5% up to here. I'm now in short-term duration. And so now we're looking at fees, because for me, fees are something that I'm always going on and on about. And reason for that is because people don't understand them. They don't realize how they're actually being impacted by the fees that they're being charged. So if you walk into a typical advisor setting, Fidelity and Merrill Lynch, and they build your portfolio with a handful of indexes. When the market goes up, those indexes are going to go up. When the market goes down, those indexes are going to go down. And all of those indexes have fees associated with them. And so you can see that here, our current diverse portfolio of 14 companies, I don't have to pay fees if I invest directly in Amazon, directly in Brookfield, directly in Dexcom. These are just equity positions. So at the moment, I only pay fees for my government bonds that are both long-term and short-term, and I pay very low fees for that. Now, I have a typical growth portfolio here, and I'm showing this because it's important to realize what's happening when you go into a meeting. So if you go into a meeting, you do a risk questionnaire, something like this, and they say, hey, here's your portfolio. We've given you these positions with mutual funds and ETFs. And you see the name Vanguard and you say, wow, I've got a really good advisor, because you've heard that Vanguard has extremely cheap products. And so you have a sense that you're really getting a deal. And that's true relative to their peer group. The Vanguard ETFs and mutual funds can be less, you know, it's a competitive market. So sometimes Vanguard is cheaper than Fidelity. Sometimes Fidelity is cheaper than a Vanguard fund, but let's still add up the fees that you're adding into your portfolio. So 52% of your portfolio is the S&P 500. This is exactly what we looked at earlier. 17% is an international stock, ETF. So what that means is that you're going to follow the general direction of the international stock market, and you're going to pay 17 basis points for that. Then you've got a bond fund, 15%, and then you've got another bond fund, 55%. I'm sorry, 55 basis point are the fees that you pay. So if you add this allocation up, what you have, 16 plus 4 is 20. So that's going to give you an 80% stock, 20% bond. That is a very typical portfolio that you would have if you walked into a retail shop and they built you a portfolio. You might end up with more positions, but to my point, you don't need more positions. If you were to have these 1, 2, 3, 4 options, whether they gave you 4 options or 40 options, it's still going to end up being 80% stock, 20% equity. They're just filling it up with additional positions. Now, adding up the fees, if you add up the 14, 17, 15, and 55, since all of your money is there, every dollar you invest is going to be charged 1.01%. That's what these 4 added up are. Plus, you've got to pay the advisor who selected these 4 positions for you, right? So typically, the average advisor fee is 1%. Some charge more, some charge less, but on average, people are expecting that they're going to be quoted a 1% advisor fee. What most people aren't aware of is that in addition to this 1% fee, they're also paying for the underlying fees for the funds that they have that track an index. So when you add all that together, you've got the advisor plus the fees, and that's 2.01%. Now, if you look at this moderate portfolio, the reason why I'm showing this one is you'll notice that, again, if you walk into a place, they do a risk questionnaire on you, you say, look, I don't want to be that risky. I don't need a growth portfolio. I'm a bit older. I've made my money. I just want to save it. What you notice here is that they're not giving you a different portfolio. You're going to have the exact same portfolio 9 times out of 10. The only difference is the weighting. So instead of giving you more stock, they're going to pull back on the stock. And instead of an 80-20 portfolio, you'll have a 60-40 portfolio. It means 40% is going to be in bonds, and then the other 60% is going to be in stock. That way, it's going to perform and look like it's moderate. So let's actually look at the outcomes. Now, this is just in the last year because that's when I started, so I didn't feel like it was fair to go further back than that. But if you look at this, now we're going to start understanding correlation. Through the lens of history, the only thing in my portfolio on any given month are companies that I deem to be companies that are going to outperform their peer group. And so you see that here in a market that's strong, everything is going along, but we only have the top tier companies. When the market comes down, yes, everyone's affected by that. When the market comes up, top tier companies are going to perform better than their peer group. And you start to see this non-correlation effect start taking place. So these indexes, the orange and the red, because they're by design supposed to track an index, they're going to do the exact same thing that the market's doing. If the market's going up, they're going up kind of at the same pace. If the market's going down, they're going down kind of at the same pace. They don't have any opportunity for you to generate what's called alpha, which is additional revenue past the benchmark, because that's not how they're built. That's not what they're built to do. And so you see what ends up happening for a portfolio that has non-correlated, high quality companies in them. And keep in mind, this is really key. You're paying 2% of every dollar you put into this investment for funds that are just tracking an index, regardless of which of these three options you select, right? The difference is in a down market, options 2 and 3 are charging you 2% in fees, but they're not providing you anything in return, because by definition, a passive index or mutual fund or ETF is not going to be able to return alpha in a down market because it's following the direction of the market. So we're going to talk about what we do to avoid these large dips later in the conversation. But this is just walking through what happens when you build that portfolio with high quality companies. So when the market goes up, again, I've got these high quality companies that are performing better than the average. When the market goes down, I can look at the reason behind the contraction, and I can shift my portfolio to companies that may benefit as a result of the pullback. So I'm going to get into that in a second. So for example, actually, I won't even tell you yet. We'll get into that in a second. So you might be wondering, okay, if that's the case, why should I ever have a portfolio of ETFs and mutual funds? And the answer is simple. When the market is humming along and everything is performing well, like it has been over the last 10 years, in a general uptrend, there's nothing wrong with having high quality ETFs and mutual funds that have low fees, because it's easy to understand and it's actually very difficult to beat the market. You know, it's not something that most people are able to do persistently, right? And even in my case, I would say that it's fair to it would be nice to look, you know, fast forward 10 years from now and see, okay, compared to the general market, how well did you perform relative to everything else as it went in a general uptrend, which is what markets usually do. But I'll put an asterisk and say, yes, you should have ETFs and mutual funds when the market is generally going up. But in a market like now, where the market is generally going down or is generally very confusing, expecting or hoping to log into your account and look at your positions and say, oh, I hope this does better than the market today, it's a false hope, because it's not designed to do that. It's because it's covering the same index as the market, as a correlation of 1. That's the point that I'm trying to point out, or a correlation that's very close to 1. So in a market like that, it makes more sense to start getting laser focused, to take the profit that you've made during those uptrends and say, okay, what are some things that I can do? What are some companies that I can do to put my money to work? So now I'm going to talk about our fee structure. So this is just showing how it works. So let's say you have an initial balance of $100,000, and by the end of the year, our performance is 24%. Right now, we're actually at 32%, but let's just say at the end of the year, you're at 24%. I'm trying to scale it back because, again, I can't read the future. So at the end of the year, you would have $124,000. Now, we still charge the same 2%, the same way that, you know, the advisor plus the ETF or the mutual funds that you have in your portfolio. So on that $24,000 of profit, we would have about $2,480 in fees. And then we also have a performance fee because we're performance oriented, which means that the more alpha, the more money we can make an investor, the better it is for the investor and the better it is for us. And anytime we generate alpha past 5%, we participate at 20% of the profit. So in a market like now, where the S&P is negative and our clients are positive, what that means is we participate in that performance alongside of them. And what that performance is just 20% of performance after 5%. So on that 24,000, the first 5% is free. That goes to the investor. So that 5,000 of performance goes to them. The remaining 19,000, we charge 20%. So in total, the client is going to profit $17,720 as of today, if we were to hit the stop button, as opposed to being in a situation where the market is down. So I spent a lot of time talking about fees. I shared this infographic on LinkedIn earlier in the week, and I can actually email it to everybody who's interested. This is just one of the like 5 or 6 pages on the infographic, but I think is really important to understand. So we've spoken about fees. For every 1% that you pay in fees, that equates to 10 years of retirement income over the span of your lifetime when you start to actually spend your account, when you start to spend those assets. And so that's expensive. You can see the two examples below. For an individual that's earning $30,000 a year, they're going to pay $154,000 in fees just to have the account open if they're not careful with the funds that they're selecting and the fees that the custodian is charging or the advisor to the plan is charging. If you had a $90,000 a year salary, as you can see, it gets even worse. You're going to pay $277,000 just in fees. And so the question is that's fine. I don't have a problem paying an advisor for fees, but what am I getting for that? Especially if the only thing in my portfolio are a bunch of funds that are tracking the same thing, right? You start to wonder if that's worth it. So now going into the next question, we're going to talk about the power of loss. Now that we understand one thing that affects the portfolio, which are fees, let's talk about the power of loss, which is if you're losing money in your portfolio, how is that impacting you? So we'll let everyone kind of look at this question. The question is, if you've got a portfolio and you lose 20%, how much do you need to earn in order to get back to your initial balance? It's a mixed bag. It's really a mixed crowd. Who knows? Who knows what you need? Who knows what you need? Let me see how many responses that is. I give everyone a chance. Yeah, okay, good. That's everyone. All right, great. So it looks like there's a split. It's either 25 or it's 35, but we all know that you need more than 20%, which is good. If nothing else, we're glad that we understand the power of loss. So let's look at it. Great. So now overwhelmingly, people are saying 25%, and that's absolutely right. So moral of the story, you have to avoid large losses if you want to maintain your position when you're earning profit during the years that are good, right? So if you look here, a 10% decrease, 11%. We asked the question for 20. If you lose 20% in your portfolio, you got to have 25 to make it back. You know, I've seen some accounts in this 25% range. And even right now, you can look at, you know, where the market is today and where it was a month ago, a month and a half ago. Just because the market had a good week last week doesn't mean very much. If it had a large loss and the only thing in your portfolio are ETFs and mutual funds that are tracking that large loss, they're just going along for the ride. Now, the only time you ever see anything past this 50%, like a loss of 75% or 90%, is when you're investing in something that you don't understand. So one caveat that I always tell investors is if you're investing in something, make sure you understand what you're investing in. Don't just hop into an investment because it seems like a big opportunity. I think the simplest example of this is Bitcoin, right? A lot of people invested in Bitcoin not having any clue whatsoever of what it was, how it worked, what it was supposed to do. All they saw was that it was making tons of money, right? And in a scenario like that, you're gonna experience the probability of loss to be a lot higher purely because you don't understand the investment, right? You don't know when you should get in. You don't know when you should get out. You can't look at an investment through the lens of history if you don't understand what the investment is. So I would say most people are kind of in this 10, 20, 25% range during their lifetime where they'll see these negative hits to their portfolio. And it's important to understand that as they start trying to make that ground back, that it actually takes a bit more in terms of performance to do that. And if you're tracking an index, that performance is going to be delayed because you're just following the direction of the market. Great. Here's the next question. Oh, you guys are ahead of me. Great. So when the shelter in place is lifted, how will the markets respond over the next year and a half? So this is basically saying, since everyone's portfolio is full of ETFs and mutual funds that track an index, as soon as this shelter in place is lifted, what are the experts forecasting in terms of market direction? So we got overwhelming 80%, 75% are saying that, hey, look, as soon as this shelter in place is over, markets are gonna kick back up, and we're rocking and rolling, and we're gonna go back to the good old days. Okay, great. So actually every single forecast that's out there for every major index is showing a loss. So you can see that here. What I've done is I'm showing you guys the price as of yesterday. So if you look at the Dow yesterday, this is where it closed. It closed 455 points up, right? So it's no surprise that the majority of the people on the response said, hey, I think that it's going to go up because the last 2 weeks, the market has been going up. But look at what the experts are saying. Although we have a 1.9% return, these are big returns for indexes, by the way. Usually they don't shift this much on a day-to-day basis. But if you look at Q2, Q3, Q4, and Q1 of next year, the markets are not expected, no matter what country you look at, there's no market that's expected to actually produce positive returns over the next couple of quarters. So this is a year and a half. Now, again, I put an asterisk next to this and I say, forecasts aren't perfect. You know, we've been watching these coronavirus updates where we see a lot of forecasts on the number of deaths that are forecasted. And if we can flatten the curve, then we can perform better than the forecast. So it's not to say that this is perfect, but it is to say that it's information that I should consider if I'm looking to expect my portfolio to perform a certain way that's in disagreement with the general investment community, right? So let's just keep going. So what does that mean? How can you avoid it? What should you be doing? There's 3 things that I'm doing on a continuous basis. We've spoken about selecting high quality companies. The second is cash management. And the third is due diligence. So I would say, what is the secret then? You know, why doesn't everyone do this? How come every investment firm isn't making, 40% return last year, 20% right now, et cetera, et cetera? How come only certain investment firms are reporting a gain? And why are other investment firms reporting losses right now, right? It's earnings season. So we're seeing this back and forth where some companies are profiting right now and others aren't. What is the secret? The secret is cash management. So I've been speaking a lot about, hey, when you're in a general uptrend, you've got an option. You can remain in those positions or you can start to rebalance your portfolio and take profit. Now, that's exactly what we're doing for our clients on a day-to-day basis. This green line represents our cash position at various points in the life of the fund. And what you'll notice here is that as we started to make money in the fund, we didn't remain 100% deployed in those positions. We started to take cash so that we could lock in profits for our client. Again, we're performance oriented. So if we make a lot of money and then lose the money by the end of the year, nobody wins in that scenario. So our goal is to lock in profits for clients so that regardless of market direction, they're able to maintain those good decisions that were made previous to anything that we can't foresee in the future. So what you're looking at here is how we've been reporting this to our clients. We send this out at least every 2 weeks just so they can track what's going on. And what you see here, November 17th was the first COVID case. Now, when I first saw this, I didn't think too much of it. I didn't know anything about it. The only thing I knew about disease in general is since this came out of China, there was a swine flu going on in China that devastated the pig industry. And so in the back of my mind, I was like, virus in China, that was a big problem for the pigs. Maybe this would be an issue. But honestly, not much was done in terms of making a big shift from a cash standpoint. The blue line shows Bay Street's performance. The red line shows the general market. So these red lines are your ETFs, right? So you got the S&P and any ETF that tracks the S&P. So we're doing well. Again, these are high quality companies. At the end of the year, we took some profit for clients. We rebalanced 12% of the portfolio to cash. Going into January, so literally a couple of days after that rebalance, we had the Iran missile issue. And for me, I thought that was going to be a big deal. Again, you can't predict the future. But when that happened, I was concerned that my clients' portfolios was going to go down because there's going to be some sort of thing that this thing kicked into. And so what we did is we shifted the portfolio. We took more of the profits that we had earned the previous year, and we weighted the portfolio to include aerospace and defense companies, right? Those companies were not in our portfolio prior to that strike, and they did not remain in our portfolio going into February once it became apparent that there was not going to be any sort of major issue with the back and forth bickering going on between the two countries. But meanwhile, we have this cash position. Now, what does that allow us to do? It gives us the freedom to make decisions without being forced into them, right? So during this month of February is where this COVID issue started really spooking people. But at that time, we had cash. The S&P went down from February 20th to the 27th by 11%. Now, in a market that has been going up for 10 years, an 11% drop in a week showed weakness for me. So at that point, we took 44% of all of our clients' money. We moved it to cash. Why didn't we move everything, you ask? Because I could be wrong, just like I was wrong with this missile strike thing. Like I thought that that was going to send the markets down. The markets didn't care about it. As you can see, we still outperformed the market that month, but I could have been wrong. So you don't completely exit the market. But here, although our portfolio saw a loss of 3%, these are high quality companies, the general market went down 8% in February. March was still a down month. Now we've understood the power of loss. So you're seeing what's happening. We lost 3 plus 7.2. That's 10%. We've got to make 11% back on the 66% of our portfolio that's in the market. Whereas somebody else who's got a bunch of ETFs and mutual funds, they've lost 20%. So now they need 25% return in order to get back to where they were in January, right? Meanwhile, for our clients that experienced that 10% loss, it only impacted 66% of their portfolio. As soon as stocks hit a bottom, we took all of that cash that we had and bought stuff for super cheap, right? Now, if you have 100% of your assets invested in ETFs and mutual funds, you don't even get to make this decision. Why? Because you're at a 20% loss right now. You can't sell your equities at a 20% loss and hope that you can, guess and check on, oh, this company dropped 30%, I'm going to buy it today, right? You've got to have the cash on hand. So from my perspective, what makes our approach towards building a portfolio that's resilient regardless of market direction is how I'm actively managing cash for clients on any given day. So you can see we deployed that money. We had a great April. The market also had a great April, but again, you've got a long way to go from that 20% loss in order to get back to where you started. Whereas we experienced this 15% gain on 96% of cash. And then once we had a good month, we pulled back and took profits, right? So you can see going into this month, May, we're currently sitting 10% of our assets for our individual clients is in cash. So let's go and actually show what happens when you do that. This is year to date. This is the S&P 500. And as we spoke, again, it's had a good little uptrend since the middle of March. But since the year started, the S&P is still down 10%, right? So it's got 11% to go before it gets back. And we've all just watched and understood that markets are expected to close lower next quarter, the following quarter, all the way into Q1 of next year. Again, it could be wrong. We'll find out. Regardless of if it's wrong or not, here's our fund's performance. So we already walked through this green line, which shows our position in cash. We've already explained the blue line is our performance relative to the market. This black line is showing you how our clients' portfolios perform though, as it pertains to what happened when they saw that slight, or I'm sorry, that slight dip. And now you start to see the power of prudent cash management. Although the portfolio took a slight hit in the month of February and March, look at the month of April when we deployed all that cash to take the gain for these companies that were at discounted prices. And now you can see, again, month of May, we're going into May with the strong performance, but also with plenty of cash, so that if we want to purchase something, we've got the cash to do so. We're not stuck in a situation where if the market's correct tomorrow or something like this, that we have to wait and kind of hope that the positions that we're in come back positively. Great. So now let's walk through, and I'm going to actually show you guys how I make some of these decisions. Again, at the start of the call, my hope was that I could show you not just what our fund is doing, but if you're managing your own money, you're kind of into that thing, just some tips that I think will help you as you go about making decisions. And I'm going to walk through some of the positions that we have in our portfolio as of today. And if you've got questions, so far nobody's asked any questions, but if you've got questions as you look at this, feel free to pop them in. So I'm going to cover 3 positions. I'm going to start with one of our positions in Tesla, so everyone can see this. Hold on, let me get this out the way. All right, great. So again, through the lens of history, I've been watching Tesla for quite some time. You'll notice that this is a 10-year chart. So this is 2013. The stock has just been kind of floating along. This white line shows the 50-day moving average. So the white line is the average price every 50 days. It's just adding up the last 50 days, divided by 50, and then you get the average price. The red line is the average price the last 200 days. So anytime you see the white line go above the red line, that's a sign that the position is probably going to appreciate in value. Again, it's not foolproof, but we're talking probability. And when I'm making investments for clients, I want to make sure that from a probability standpoint, I'm going to be more right than wrong most of the time, right? So now, fast forward to 2019, we took a position in Tesla at 450. You can see I waited for this white line to cross over my red. That gives me signal that the position is going to outperform. And then you see the average price over the last 200 days was 444. So I took a position in Tesla at 450, right? So every client we had, we took 14% of their portfolio and we put them in Tesla at 450. That's a data-driven decision. We can back it up. And all of our clients, for the most part, understood why we were taking that position when we took it. Now you'll notice that Tesla at that point seemed to be the best decision since sliced bread. It went all the way up to 968. And again, just like the rest of the market, when this COVID thing started popping off, it saw a huge decrease. And then it's right back along where it started. So right now it's at 819, right? So this has been a great trade for our clients. You might be wondering, why'd you pick 14% of your portfolio? The reason why I do think it makes sense to have an investment advisor is because it's kind of an art, right? Like, why do I like Tesla more or less than I like another company when I'm looking at the same quantitative and qualitative data as another individual? Why would I have 14% of Tesla and then let's say I have 14% of Brookfield as well, right? Those sorts of decisions are going to be based on the subject matter expertise of your advisor. And another reason I like showing charts like this and walking you guys through investment decisions is because I understand that my clients also have a subject matter expertise. So for example, I had a client, he called me and he said, hey, why don't we buy some Qualcomm? And I said, I don't know anything about that. And he said, look, Qualcomm is going to be a company that they've got this 5G coming out. Nobody can really compete with them. I'm in that space. I understand it. That's a good company to invest in. And initially when he told me that, I looked at the chart. I said, I don't like the chart right now, but I'll keep my eye on it. And sure enough, it started to look decent. Now, again, I don't have a subject matter expertise on it, but at least I've got a client who's along the ride with me, who can be aware, hey, I understand the process that you're taking as you go through these decisions, and this is how you should go about or here's a company that I think you should look at as you're making that decision. So the next question I want to go through is, okay, we see that you understood when to buy. You went in at 444. You've been talking about prudent cash management. When do you start selling and taking profit from this trade? Do you just hold it for forever? And so now I'm going to show you guys how you go about doing that. So now what you're looking at, this is something called a Fibonacci. And if you look at these charts, let me actually make this a little easier. Like, well, actually, let me back out just a little bit. I think this would be a good, yeah, this is a good view. So now what you're looking at, this is showing me what I can expect this position to do. And this is just one of the indicators that I can look at. But again, it's important to understand. So now each of these lines represent a certain price where I can expect the institution, so institutional investors, these guys with big money, when are they going to take their profits? When are they going to get into a position and sell? When are they going to get into a position and short? Typically, if you're looking at this 50% and 61%, you'll notice that anytime the price bounces in that range, so let's look at the 50% line, you'll notice anytime the price gets near that, it either corrects up, and as soon as it got near this 23%, it corrects back down. Once it got to this line, you got a decision. So you're taking these decisions, you're looking at the chart along with all the other information you have, right? So when I'm looking at this, let's fast forward to today. We're in this position at 450. We've been taking profits all the way up. So right now, you know, we're still sitting at about a 14% position. Some clients have a little less because of the way their portfolio is designed. But right now, you can see this is boosting over this 23%. And I can expect one or two things. It's either going to continue to play in this range as it tries to break back up to where its previous high was, or people are going to take profits here the same way that they did right here, right? This is just a couple of days ago. If you look at the bottom of the screen, it says January, February, March, April, May the 1st. So May the 1st, it got kind of in the middle range and it started to come back down. It hit this 38.2, and then what did it do? It started to come back up. So this becomes, again, not such a difficult decision to make as it pertains to when do I enter and exit a position. Good. Another thing you will look at is this bottom that says RSI. So RSI, what that is relative strength index. And relative strength index is telling me, let me see if I can, no, I don't want to do it like that. Hold on. I want to do it like, I want to try to show you what it looks like. No, not like that. Do it like this, yeah. I'm going to do it like this. So I can't show you, let me see. Actually, I should be able to show you. Yeah, here we go. Okay, that's better. Now you can see it a little better. So now what I'm looking at, I've got my bands, so I have a sense of what this price is going to be doing. I've got my moving averages, so I can see if this is supposed to make its way up or supposed to make its way down. But I also know my relative strength. Anytime a stock is more than 70, it means it is overbought. So overbought means that too many people are buying this stock. The price is too high. It's not supposed to be that high. And institutions are going to look at that number and they're going to start taking profit because they're going to say it's not supposed to be this high. You look at Tesla as of yesterday's close, and it is currently at 149. That's double, it's more than double the overbought signal. So for us, this is a sign where we can take 3 to 4% of our allocation and take profits. Again, we could be right, we could be wrong, but we're taking this into account and we're saying, look, as of what I'm looking at today, we've made plenty of profit here. Everyone else feels like they missed out. So now they're trying to buy this at a much higher price than we purchased it at. We can take some profits here and then wait for the price to correct back to this 50% range. And we can enter in for our clients around here. I actually, the individuals I did this for last week, they're not on the call right now, but I had a client that was not our client way back in 2019. And they wanted to buy Tesla in the month of January, February, March, April. And in April, as you can see here, Tesla was like scooting its way up. And so what we did is we took a 5% position. We waited for the correction down to the 630s price, and then we purchased in a range that we felt was suitable as we saw this continuing to attempt to break above this 38.2 band. All the meanwhile, if you look at the RSI down here, we can see when there's opportunities, this purple line on the bottom is 30. So when it's oversold, people have sold too much of it. And the top purple line is 70 when people have overbought it. So this is how we're going about shifting the portfolio, maintaining an appropriate cash position so that if this actually were to do what I'm expecting, which is go down in the near term, I'm not saying it's going to go down Monday, but what I am saying is that you see this like huge spike up here of 246. And if you look at the price, what happened? Over time, it dropped, right? It was oversold. It should have never been, it should have, my point is people who were buying it at this point are kind of stuck holding this super high price, right? Because they're just following the news, right? So, I wish I would have bought it last week, but it's okay to buy it this week. Shoots the price up, not in their best interest. The other thing I spoke about was, okay, when you've got something like a pandemic that affects a lot of companies, thinking through, well, okay, I might not have these companies in my portfolio today, but maybe I should think about what are some companies that are going to perform well because of or as a result of the pandemic. And here's a company that we invested in on March the 26th. This investment was made because of the pandemic, no other reason, right? So if I back up out of the chart, most people probably aren't familiar with this company. Dexcom is a diabetes company. You could consider them like kind of in the still startup range, although they're large. But what they do is they make diabetes equipment, so apps for your phone. They make diabetes equipment. And what you can see here is this stock is currently higher than it's ever been in the history of its stock price, meaning that COVID has actually put this company in a better position than it was pre-COVID. Now, why did we make this investment? As soon as California came out and they said there's going to be a shelter in place, I started to think through, well, what does that mean for companies? Okay, diabetes is something that in America increases by a couple of percentage points every year. So diabetes in America goes up every year. What do you think happens in an environment where everyone's sheltered in place? So they're not exercising, they're just at home in their house, maybe walking once or twice a day, maybe, and they are eating and staying at home, no real mobility, not doing anything. I actually thought, diabetes would probably go up because nobody's exercising. And now you see why a company like this is trending higher. Again, we took a 5% position. Why not 10%? Why not 15%? That's the discretion of the advisor, right? For my portfolio, for the risk that I was willing to take on that thought process around what's a high quality company today. So again, it was high quality before, right? It was on its way up. It's a high quality company, but I think that diabetes is going to cause a problem in the short term. Which company am I going to invest in? I fell on these guys because of a whole bunch of underlying qualitative data, the company pre-COVID, but also you can see for that 5% position, now we're in a situation where whenever we decide, so if we look at March 26th, when we took this position right here, when do we want to take profit? We've got plenty of room. And really, there's no hurry to make any decision because it's at an all-time high. So we can wait for this to kind of correct down here. If it does, we can take some profits. When it corrects here, we can buy back in around 38.2, so 338. We can buy some more at 326. My point being, we bought this at such a cheap price that the cash management that we're doing for our clients, it makes it easy for us to decide when do we want to get in, when do we want to get out, when do we want to add more, when do we want to sell some of that position. Again, you can see here the RSI is oversold. So now what this is telling you is that people who missed this investment, they're trying to make it now, right? So they're buying something that they should have bought way back here, which means if it's oversold, I can expect from a probability standpoint, over the short term, this is going to start winding its way kind of in this range, right? Then the last one I'll show you guys is our largest position. And I'm going to finish with this and open it up for question. So Brookfield Renewable Partners is my favorite company. Even just talking about kind of the fundamental purpose behind owning an investment firm, you know, Warren Buffett is a person that people shoot around as, you know, this guy makes all these brilliant decisions and all that. And what I will say is something that he is able to do that's very attractive to me is he owns such a large percentage of a company that he can influence from a governance standpoint, things like board positions, things like governance, things like general direction of the company, right? If you own 7% of American Express as one individual, you know, 12% of something like Visa, MasterCard, et cetera, people start listening to you when your asset management firm holds such a large amount. So as of today, Bay Street, we're the 123rd largest holder of this company. And I would like to, over the lens of history, be like in the top 5, you know, so one of the top 5 asset management companies for this particular position. So what that means is whenever we have a client, it doesn't matter what their situation is, we're taking a position in this company with the ultimate goal in the next couple of years of actually being a major stakeholder so that we can start influencing, you know, who are the board members, what's the direction of the company, what's the general standpoint from a governance standpoint. And for me, that's a really big deal. We can't do it, of course, in every single position that we take, but I have always felt that renewable energy through the lens of history is going to outperform the market. You know, some of you have received the reports that I've done over the past on renewable energies. And you've seen, if you compare a chart like Brookfield, I'll just show you Exxon very quick, to a company like ExxonMobil. So this is showing you the direction of combustible gas, right? Now, if you guys think that this is going to somehow just magically flip-flop around, you know, the next 10 years from now, I would say we've missed the purpose of thinking through the lens of history, because this is showing us all the way back since 2013 that renewables in general are outperforming these oil companies, right? See, it's the exact opposite direction that we're looking at here. Again, although there was a dip as a result of the whole COVID piece, I really like this position. And as we bring in new assets and as we bring in new clients, the goal is actually for our shareholders, so all of our clients, to be able to influence when it comes to voting day and things like this, who's actually running these positions. And, you know, several of you on the call are familiar with things like ESG investing or CSR investing, corporate social responsibility investing. And that's really what we would like to impact. We'd like to see, you know, a diverse mix of individuals. We'd like to be able to have our voice heard as it pertains to the renewable space. And right now, although most people aren't familiar with Brookfield Renewable Partners, they're a very large company. You know, about 40% of their resources, they do hydropower, so a bunch of water. They also do some solar stuff, is overseas. And then the rest of it is in the US. And we also have a position in Xterra, but they're much too large of a company for me to try to have a large percentage in. So ultimately, I'm finishing with this chart because just to give you guys an idea of, aside from market direction, so my point being, if you have a really large position in one company, you're kind of not influenced by market direction like you are with all your other positions, because you're thinking way long term, right? So with the company like Brookfield that pays a 4.5% dividend, we're already generating revenue for our clients that need income because it pays a strong dividend. But more than that, if we're able to influence at any given time in their business cycle who they're hiring, who they're firing, who's going to be the next board member, who's going to be the next president, et cetera, as we you see these calls here. So these calls are showing like earnings call, conference call, et cetera. If we're able to influence what that looks like, we have a much bigger stake in this company, and we're not worried about these short-term corrections like this, right? What we're saying is, look, we've determined we want to invest through the lens of history, and as an organization, we're going to start determining who we want to help us accomplish that goal. So now I'm going to open it up for questions. I'm going to have to figure out how to make it to where people can speak, But for now, if anyone's got specific questions about anything, feel free to let me know. I'm a couple minutes over, so if anyone's got to go, that's also fine. But yeah, I'll open it up and we'll go from there. There I am. And then let me see if I can. All right, so I do have a couple of, oh, there's a lot of questions. Oh, there's a lot of questions. There's a lot of questions. Okay, so hold on. Oh, this is a great question. So Drew asks, how much does your fund weight in foreign stocks? Does your fund return a dividend? So that's a great question. Drew, I do not like international equity because it underperforms relative to the stocks that I invest in. So for me, Brookfield actually is my diversification into international firms because I know that they have a diverse portfolio. So the opposite of something like Brookfield would be like Nextera, which is a US-based renewable energy company, and they own things like Florida Power, right? So they're a very large company, but all of their assets are in North America. Whereas Brookfield, all of their assets are spread out across the world. And so for me, since I know that they're a higher quality company, I'm not attempting to find tons of other companies to create diversification when I know that this particular one in general is accomplishing that for me, right? So we have I think a 9% position in Nextera as well, and that's going to knock out my and Nextera actually also pays a dividend, if that's your question. The other part of his question was, does your fund return a dividend? So the answer is yes, because some of the positions in the portfolio are dividend paying companies, just like Brookfield. So although Tesla doesn't pay a dividend, for example, Brookfield does pay a dividend. Nextera does pay a dividend. Brookfield Asset Management pays a dividend. Hold on, I'm going to share my screen again. Share my screen again. Share screen. And then I'm going to click on model. And then I'm going to click on. All right. So guys, what you're looking at here is how I rebalance portfolios. I mentioned, how I shift based on various scenarios. You can see the portfolio shifting as a result of the bombing. You can see our model portfolio. This is when the market's just humming along. You can see this one that's being shifted on a week-to-week basis based on what's going on in the market. So to your question on dividend, Amazon doesn't pay dividend. Brookfield Asset Management does. Brookfield Renewable Partners does. Brookfield Asset Management actually owns like 35% of Brookfield, thus the same name. They don't own the whole thing, but they purchase a large stake in it. Dexcom does not pay a dividend. These are bond funds, so they do pay a dividend. They're bonds. Nextera pays dividends. Netflix doesn't. ServiceNow doesn't. Oaktree is purely for the dividend. So Oaktree, they're the largest debt management company in the world. And this stock is not meant to produce growth. This stock is in the portfolio to give me a foundation of safety. So if you look at it, I'll just show you what it is real quick. Wait, why is it doing that? Great. So you'll notice this thing does not really move much. Again, this is the whole shock to the market. But the reason why this is in my client's portfolio is because of here. It pays a decent dividend. I mean, you could consider this a massive dividend, right? And really in real life, this isn't a stock that appreciates very much, right? This is just kind of just humming along, right? This right here, again, was a result of panic, and it's already back to where it was going. Again, they focus on alternative investment strategies, and basically, just be really straightforward about it. What they do is they restructure debt. So I invested in this company because when the government came in and they said they were going to give all these loans to all these businesses, in real life, what's going to happen in 6 to 9 to 12, 18 months from now is those companies are going to start defaulting on those loans. And companies like Oaktree, these guys were at like $18 billion. They've been in business like 26 years or something like that. They raised $19 billion as a result of COVID. So when all this happened, they doubled the size of their fund in preparation to start coming in and restructuring debt. So that's what I mean by thinking through the lens of history. I'm not concerned about this dip right here. This means nothing to me because my clients are receiving an 11% dividend on their money, regardless of what's going on. And it's the underlying investment is very sound, right? I know that these companies are going to default in their debt. I've invested in the highest quality company there is in the debt management space. So even if other debt management companies make bad investments and go out of business, et cetera, you know, I'm not in a position for my client's portfolio where I'm in this position to make a lot of money. I've got Tesla to do that. I've got Dexcom to do that. You know, that's what I mean by a diverse portfolio. But as it pertains to the financial sector, I've gone the alternative investment route, and I've said, look, a company like a company like Oaktree, a company like Brookfield Asset Management, they're going to outperform the other financial sectors like American Express or Visa, for example, because of the purpose and the underlying piece of their business. I've got a question, when's the best time to invest in a portfolio? I would say it's good to start saving money whenever you're able to. That's how I answer that. It's good to start immediately. What percentage of your portfolio do you ultimately plan to invest in Brookfield? I would say it's going to stay in the like 9 to 14% range. Right now we're at 14%. The software that I use automatically rebalances portfolios, so you can see what happens, what I'm allowing for. Okay, next question. What trading platform do you use? I custody clients' assets with TD Ameritrade, which is what you're looking at here, and also Charles Schwab. So both of those allow me to, if you look here, I can trade all accounts at one time, right? So this, if I make a trade or something like this, it's going to affect all accounts at one time. Coincidentally, Charles Schwab just bought TD Ameritrade a couple of months back. So my point is that those are the two options we have. How many funds are in the lens of history? Right now it's 14, but it ranges. It can be anywhere. At the lowest point, I only had 4. So when I went 66% equity, 44% cash, I only kept 4 companies. I kept Brookfield, Tesla, and I don't even remember the other 2. It was too far back ago. Oh, I think I kept, actually, hold on, let me look, I can tell you. Yeah, Brookfield Asset Management, Brookfield Renewable Partners, Tesla, and then I kept Nextera. I didn't sell Nextera primarily because for some of my clients, I actually bought Nextera at the high. Again, I can't predict the future. So I had a client that came in and we bought Nextera way up here in the 280s price range. Not anticipating that they would be as affected by COVID as they were. Reason why I didn't anticipate that is because it's a utilities company and people are at home right now. Everyone's been getting their utilities bill. Your utilities bill is more because you're at home. So again, I think this is a great company to be in, but so I didn't sell it back then. And let's do one more question and I think we're okay. Is there a minimum investment for your fund? No, there's no minimum investment for our fund, but you can caveat that with, if you open an account with, like, let's say you start with 0, then we wouldn't be able to buy a diverse portfolio. We'd have to kind of dollar cost average your way in, right? Because for example, Amazon costs, like 2,000 something a share. So if you only had, let's say, $1,000 in there, we wouldn't be able to buy the whole portfolio on any given day, but we would be able to over time if you're contributing, some amount per paycheck or something like this. we would be able to get you there, but you wouldn't start out with exactly what you're looking at today. Someone said, do you invest in startups? We don't invest in startups right now with clients' assets, no. In the future, that might look different, but it's not going to look very different because as far as I'm concerned, from a risk perspective, they're extremely risky. So even if we did, it only would make up 1 to 3% of the portfolio. And we'd have that 1 to 3% there very similar to this Dexcom position, right? With the idea of, hey, maybe this works. If it works, great. If it doesn't, then we only exposed, 1 to 3 to 5% of the portfolio to that decision. Where do you see Bay Street's market position 10 years from now? So again, for me, I would say long-term, my goal is to have very strong positions in a handful of companies, because from a governance standpoint and from a long-term thinking standpoint, we won't be as affected by these short-term market corrections, and we'll be more interested in things like the direction in general of the companies that we're invested in. I think that's good. What's a good initial investment amount with Bay Street? I would say it depends on your circumstance. Every person that I speak to is different. I have some people, again, who've opened an account and they add money every month, and that works for them. That works for their situation. I have other clients who, they've accumulated a lot of assets, and for them, it might not make sense to move everything at once. And we might not even put 100% of their assets in this fund. It could very well be we've got clients that we just managed cash for them. And for cash management, they're not in a fund like this. They're just coming to us because they want to make more than 1 or 2% in a money market. And so we're just trading fixed income products for them. Someone said, is it easy to transfer an existing 401k? It's easy if you no longer work for that company. So if you have a 401k, and you have a job, you can't transfer your 401k while you're actively employed at that same employer. But if you have an old 401k and you want to shift that to an IRA, yes, that's very easy. That's something we can do in like 20 minutes. Anna asks, wait, I lost your question, Anna. What changes would you try to make to have Brookfield implement when you can influence them? So every couple of weeks, literally, we get voting. You get these pieces of paper in the mail where you vote for decisions that companies are going to take. Since they're publicly traded and the public owns them, they have to include the shareholders in those decisions. So what we're speaking about is from a governance standpoint. If they have a meeting and they're going to be replacing members on the board, we would want to say things like, we want to see minority representation. We want to see women representation. We want to see diverse representation, because we are aware that companies that have a diverse team outperform their average peer group. Brookfield does a decent job with that, but I personally think they can do better. And those are the type of decisions that I think really start to become interesting if you own a decent sized position of the firm. Right now, it doesn't really make much of a difference because we don't own enough shares to be noticeable, but in the future, that wouldn't be the case. And then, so what I'll do, just so we don't go too long, let me see. Well, everyone's still on the meeting, so I guess that's good. Let me see. Oh, someone said, what's the initial size to become top 5? I'll actually show you. That's a great question. So the way you track this, every investment firm is required to file something called 13F filing. And that's where you can see who owns what. And it's really interesting because you can get a sense of what the big boys are doing. Now, when I say required, it's an option. You're not forced to file them. But a lot of hedge funds they have to file them because they have to report what they're currently invested in. So can y'all see this? Yeah, you can see it. So now we're looking at BEP. We can see a 13F filing. And now if we look at ownership, we can see that Brookfield Asset Management, the company that they took the name, Brookfield bought 35 or 31% of this company. And when they bought the company, they changed the name, right? Now that in itself is proof of what happens when you own a large percentage of a company. Just by owning 30% of it, they changed the name from whatever it was to Brookfield Renewable Partners when they took ownership of it, because Brookfield has an extremely strong brand recognition. That's an asset management company out of Canada. You notice that prior to this conversation, we already have a 10% position in Brookfield as well, right? Reason for that 10% investment is, again, Brookfield does alternative asset management and not traditional like Bank of America type asset management. They're investing in things like real estate, oil, natural gas, renewable energy, things like that. Primarily real estate and renewable energy. So now coming down, if I were going to be in the top 5, 1, 2, 3, 4, 5, you can see market value. These guys have $100 million in one position. So this kind of gives you a sense of kind of what I'm aiming for. Right now on 85 million of assets in a 10% position, you're looking at $8 million, right? And so the hope is, as I continue to expose the performance of our fund, individuals, even if they're only opening an account with their old IRA or 401k, they can also start telling their employer, hey, we want Bay Street to manage our retirement plan. And the retirement plans are really where the opportunity is for me, because a retirement plan can range anywhere from, 5 million, 10 million. Our largest right now is an $83 million retirement plan. I'm speaking with some retirement plans in the like 730 million range, so if I were to take 10% of 730 million and put them into a product like this, that through the lens of history is great for a retiree. This is a stock that in 10 years from now is going to outperform relative to Exxon or some other, natural gas or combustible gas company. So this is what I'm looking at when I make statements like that relative to where we currently are in our holdings. There's the answer to that question. Can you manage safe harbor 401k plan? Yeah, so all these other questions are individual question specific. And so what I'll do, just for the sake of everyone's weekend, is I'm going to screenshot all these questions and follow up with everyone who has these individual questions later, and just finish up by saying, thank you guys for joining. And I really look forward to any feedback you guys have. Do feel free. I think at the end of this, there's going to be some sort of poll thing. So do feel free to ping me and give me some feedback on what you liked, what you didn't like. If you'd like to see some more of this, what I was hoping to accomplish was to show you guys some thought processes around how to manage your current money, as well as to see how the institutional investors are thinking through when they buy and when they exit a position, so that you're no longer caught off guard when you're looking at your resources. And also show how we go about doing that, and explain a bit behind, why we're currently outperforming and why I'm not concerned about what's happening tomorrow as I manage cash for my clients. Even if, again, the market comes down, we've got cash on hand so we can buy the dip. And when we make some profit, we're going to take some of that cash and put it back in the bank so that our clients retain their gain. So again, thank you guys for hopping on. I really appreciate everyone who hopped on. This is great. We had 36, 37 something people that popped on, and that's really awesome. I thank you guys for checking this out, and I hope you all have a great weekend.